Hello, I'm Tiffany White with Keller Williams Realty in the Nashville, Franklin, Tennessee office. I want to take a moment today and explain what makes up a mortgage payment, just in case you are considering buying your first home, or maybe you know somebody who's considering buying a home. Just want to be sure you understand the parts. So there are four main parts to a mortgage payment. They are abbreviated PITI, and that stands for principal, interest, taxes, and insurance. So the principal is the balance of the mortgage, what you owe on the property still. And then the interest is what the bank or mortgage company is charging for their services for loaning you the money. The taxes are the real estate taxes. If you are working with a real estate agent and they're sending you information directly from the multiple listing system or the MLS, the taxes on that MLS sheet are going to be listed annually. But when you're looking at a mortgage payment, they're broken down monthly. So the real estate taxes would include like city, county, just depends on where the property is located and what municipalities are involved. And then last is your homeowner's insurance. It might also be called hazard insurance. So these four parts are make up the kind of the core of your mortgage payment. It is possible to have an additional fee perhaps from a homeowners association, an HOA, depending on where the property is located. That's not really part of your mortgage payment, but it is part of what the mortgage company or the bank who's doing the loan is going to consider when they're looking at your financial obligations and your debt to income ratio. Then you might also have something like flood insurance, or depending on your down payment, you could also have private mortgage insurance or PMI. But let's go through a really kind of basic little example for just to kind of put some numbers to these concepts. So let's assume that you are buying a $250,000 house. And let's assume for just this example that you have 20% to put down. So on a $250,000 house, 20% would be $50,000. So you would be getting a loan for the remainder, the balance of that, which would be $20,000. If we assume a 30-year fixed rate loan at a 5% interest rate, which is actually a little bit higher than rates are right now, but for this example, let's just keep these kind of round, even numbers. So at 5%, I have a handy dandy little mortgage calculator table. There's also all kinds of apps on your cell phone that would work. If we're financing $200,000, we would take the 200, just the thousands, multiply it times 5.37 for, if that's for 5%, 30-year fixed rate, 5.37 is a multiplication factor. And that would give us principal and interest payment monthly of $1,074. So let's assume that our real estate taxes are $1,200 per year, so that would be $100 per month. And then let's assume that our hazard insurance or our homeowner's insurance is $1,000 per year, so that would be $83 per month. If we add those up, $1,074, $100, and then $83, we get a total monthly payment in this situation of $1,257, so $1,257 per month. So I know maybe you're thinking, okay, I don't have 20% down. That's not uncommon if you're buying your first home, and even if you're buying your second home, it's not uncommon to maybe only have maybe 5% down. So let's do another scenario with just 5% down. So in both of these, we're assuming that there is not an HOA, that there's no HOA payment, and that there's also no flood insurance. So for 5% down, that means the down payment would only be $12,500, and our principal balance that we are financing is $237,500. So in this situation, if we are taking 237.5 times our little multiplication table, our little cheat sheet over here, 5.37, we end up with a principal and interest part of our payment of $1,275. We're going to assume the taxes are the same, and the homeowner's insurance as well. So $100 per month for taxes, $83 for insurance. That gives us PITI of $1,458. Now remember, this is only 5% down payment. So we're getting a loan for a greater balance in this situation. But because we're only putting 5% down, the mortgage company or the bank is likely going to consider you a higher risk. If you only have 5% down instead of 20%, they're most likely going to require you to pay PMI or private mortgage insurance. Honestly, this doesn't do you any good, but it in many cases is required, and it's really protecting the bank. They've got to cover their own assets. So just for kind of round numbers, it really depends. It can vary, but let's just assume that the private mortgage insurance is right around $100 per month. So our PITI of $1,458 plus another $100 would be $1,558 in this situation with 5% down, compared to $1,257 in the situation with 20% down. So that's a difference really close of $300 per month. But if you're wanting to stop renting and you need a roof over your head, you want to buy your first home, it is a very viable option to allow you to get into a house with perhaps only 5% down. Just depends on the numbers. But if you have questions about getting pre-approved or qualified for a loan, I'm glad to put you in touch with a local mortgage lender. I have a network of great professionals who are here local in town and can help you if you have questions about this. I'm not a mortgage lender. I'm a licensed real estate agent. So it's not really my specialty, but just wanted to give you this overview and can certainly put you in touch with a mortgage lender if you want to go ahead and take that step of getting pre-qualified or even pre-approved for a loan. It really is very important if you want to look for a home to know what you can afford and what your payment would be, so that don't want you to be house poor, put you in a situation where you maybe your payment is more than you would like it to be. So just to be informed, if you are looking to buy your first home, maybe you're wanting to move up or move down in house or change school districts or locations, I'm glad to help. My name's TiffanyWhite. I'm with Keller Williams Realty in the Franklin, Nashville office, and I'm glad to help you buy, sell, or invest. 615-260-5858 is my cell phone. 615-778-1818 is my office. I am located in the Cool Springs area of Franklin and work all over Williamson County, Murray County, Davidson, and just appreciate you taking time to watch this video. Maybe share it with somebody you know that would find it helpful. Thank you so much and have a great day.